Asian pharma stocks tumble after a sudden escalation of the tariff rhetoric by President Trump, announcing a 100% duty on branded or patented drugs unless there are plans to make them in the USA. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis.
The company will be valued around $14 billion. We actually think this is a good deal for investors, but ultimately the investors are going to make the determination about what they want to invest in and what they think is a proper value. The most important thing is that it does protect Americans' data security. It ensures TikTok is still accessible.
Vice President J.D. Vance says TikTok will be valued at around $14 billion after President Trump signed an executive order approving a deal to keep the platform operational in the U.S. The Indian rupee, meantime, has fallen to record lows, weighed down by tariff concerns and a recent surprise hike in H-1B visa fees. And we assess the outlook for the Indian economy and markets with HSBC's chief India economist, Pranjul Bhandari, and Kotak Mahindra AMC's head of equity research. Our top story today, tariff uncertainty making a comeback and casting a long shadow over global markets. President Trump says he'll impose a 100% tariff on branded or patented drugs starting next Wednesday, unless a company is building manufacturing plants in the U.S. Healthcare names in Asia under pressure following the news. Not surprising there. We're also keeping an eye on shares of automakers after Trump announced 25% duties on heavy trucks. On top of that, he'll also says there'll be a 30% levy on upholstered furniture, as well as 50% import fee on kitchen cabinets and bathroom vanities. For more on Trump's latest tariff pronouncements, let's bring in Bloomberg News desk editor Jill Deeses. Jill, suffice to say, these tariffs are getting really complicated, also all-encompassing, and they include the kitchen sink, literally. What is the latest on Trump tariffs?
Yeah, good point there, Haas. I think, obviously we're still trying to unpack this latest round. So this is set, Trump says, to go into effect October 1st. So that's next week. We're still waiting on some more details. But I think out of everything that he's just announced today, including those heavy truck tariffs, that kitchen, those furniture tariffs, I think everything that he's talked about on pharmaceuticals is by far the most interesting here. So first of all, I think really important to note that in this announcement from Trump, he was talking about patented, branded pharmaceutical drugs. So presumably that would exclude generics, which might be a little bit of a relief for nations like India. But again, I think we're still fairly early on in trying to decipher what some of these may ultimately mean. The key part of this is that this 100% tariff on these branded or these pharmaceutical drugs, I mean, what exactly is that going to look like when you look at all of these other tariff agreements that Trump has already reached around the world? I mean, look, for example, at the agreement that the U.S. reached with the European Union earlier this summer. That already included sort of a fixed rate for drugs. So is this something that could potentially preempt that? I think that that's one thing that's still kind of an open question here. And then, Haas, I think the other piece of this that's really interesting to note is what you mentioned on, this 100% tariff applying unless this company is breaking ground in the United States. So when you've got a lot of drug manufacturers that, might, create pieces of the drugs in other countries, bring them to the United States. Some of them already have factories in the United States, but are they actually breaking grounds on new ones? What's the status of their commitment? I think a lot of that is still something that we'd have to kind of see how that factors into the plan here. But, to your point, this just kind of shows you that, this tariff regime from the Trump administration is very nebulous. It's getting very complicated and obviously raises all kinds of new questions about, if you're a nation that reaches a deal with Trump, how much does that really mean when there could be these additional sectoral tariffs on the way?
And there's a sense that this really was a surprise move by Trump, right, Jill? I mean, it comes on the back of that deal with TikTok, and people are saying, like, where did this come from? Why now?
Well, I think the really important thing to remember, Haas, is that Trump's Commerce Department has actually been investigating a number of different industries over the past several months. So this is under those sectoral tariffs, Section 232. So these types of tariffs are presumably different from a lot of the Liberation Day country-by-country tariffs that Trump has announced. We've already seen this kind of thing in effect with things like the automotive sector, auto parts, steel tariffs, aluminum tariffs, that kind of thing. So I wouldn't be surprised if over the next few weeks, if not months, you see additional announcements from the Trump administration as the Commerce Department continues these probes. I'm still waiting for more on semiconductors, for example. That's a really big one. There could be some other metals products that the Trump administration considers. So when you're looking at these latest tariffs, I mean, again, remember that, not everything is done and dusted. And I think, I've mentioned this on this program and several others, that tariff agreements in general just take a very, very long time to sort of negotiate. So it could be that, there's a lot more that could be coming down the pipeline because, again, that the Trump administration continues to probe different industries and see what can ultimately apply. I don't really think that Trump's announcements on tariffs are going to let up anytime soon.
And we've said over and over again, brace, brace, more to come, Jill. Always a pleasure. Bloomberg News Desk editor Jill Deese is there joining us from Hong Kong. For more on the market reaction to the tariff news, let's bring in Bloomberg senior Asia equities reporter Abhishek Vishnoi. Well, we've seen euphoria. Perhaps this could, I don't know, dial it down?
A little bit. I mean, it does take the sheen off of risk on exuberance, but it doesn't change the overall thesis. I mean, it adds a risk premium. The moment came where, you thought that Trump was over with tariffs and he would move to other things. But as Jill said, this is becoming way more nebulous. I mean, even kitchen sinks, kitchen cabinets are in negotiation now. So this essentially means that the regime for risk on exuberance gets tested a bit. But all in all, it's not very big negative for pharma in particular. I mean, while the headline number is of 100% tariffs, if you drill down and look at the supply chain of pharma in both in China and India, there are certain companies, certain segments which might be getting impacted, but China's rise in pharmaceutical has been because of its new drug candidates innovation, which Big Pharma was happy to buy out even in the worst of times between US and China tensions. So that remains intact. That doesn't get touched because of this. So that re-rating continues. And on the other hand, for India, I mean, most of the pharmaceutical companies, except possibly a few names, have already got presence in plants there. So what this essentially would mean is that the building blocks for these drugs, branded or patented, that India supplies, that the demand for those would increase as the demand for US-based manufacturing of those drugs increase. So this actually might work out in their favor in the long run. But having said that, this means volatile flows, heavy FX intervention risk. So there is that risk premium that will get assigned, and we are seeing that getting translated into the markets today. I mean, Asian markets are 0.5% lower just because of that.
The thing is, chances are the market's getting used to the idea of Trump tariffs and could see the dips as a buying opportunity. Is that a fair assessment to make?
Absolutely. I mean, markets have been getting used to almost everything. There's just so much liquidity out there, and now Fed is turning positive. There were 2-3 wars going on, but we are seeing markets scaling record highs, and now even Asian markets are turning. We are looking at bellwether stocks in China coming close to record highs. I mean, that was long time ago. So markets are in very much a buy on dips mode, but this does temper the thesis for some markets. And for example, it won't touch the pharma industry in India, but it does add that risk of vibe to India, and it does match with that H-1B visa that India is facing. So it does go in the direction of, again, America first policies of Trump weighing on India valuation. So earnings might not get impacted, pharma may benefit in the long run, but that multiple of India 20 times, that will get reduced, and possibly something similar for China.
And that's the one to watch. Abhishek, thanks. Bloomberg senior Asia equities reporter Abhishek Vishnoi there. Now, President Trump is advancing plans for American investors to buy TikTok's U.S. operations from Chinese owner ByteDance. Beijing has yet to declare publicly whether it has granted approval, though Trump says he was given the green light.
This is interesting because I had a very good talk with President Xi. A lot of respect for him. Hopefully he has a lot of respect for me too. And we talked about TikTok and other things, but we talked about TikTok. And he gave us the go-ahead. You know, it's run by American investors and American companies.
For more, let's bring in our Asia tech correspondent Annabelle Drulis in Hong Kong. Belle, what was in the executive order?
So it was essentially, as you kind of heard some of the contents there from President Trump, but outlining exactly how the divestment of TikTok's operations in the US, or the sale of its operations on the US app, meets the conditions for it to be approved by the US. So things like, as President Trump said, that it's going to be owned now mostly by American investors, operated in a joint venture structure. That was also contained in the executive order. ByteDance as well, going to have less than a 20% stake, and that there's going to be a new board of directors as well that will oversee the operations. That executive order signing happened just in the last few hours, but of course big question marks around the eventual buys. For instance, that was something we still got some more details on from sources, but we don't have exact clarity on just yet. Still Oracle, still Silver Lake being talked about, but a new name as well that's entered this is MGX. And that's an interesting one because it's actually an Abu Dhabi-based state-owned investment firm that's focused on artificial intelligence and advanced technologies.
We heard from J.D. Vance, valuation at $14 billion. Do we know how it was determined? Has it got to do with the IP, the data, the user number, for instance?
Yeah, I'd say it's probably more based on expectations around the ad revenue side. I mean, that sort of is the primary way that you can estimate it, essentially, expected U.S. advertising revenue. But it is actually an interesting number, that $14 billion, because it's far short of what it initially had been expected, up to $35, even $40 billion instead. Some analysts that we spoke to say this is pretty much a valuation in line with their estimates for expected advertising revenue in the US this year. But our Bloomberg intelligence team actually has a different perspective, and they say that if you combine the ad sales of Snap, Pinterest and Reddit, they actually do think TikTok is going to surpass that. But those three social media apps have a combined valuation of $80 billion. So it's really quite far short of that.
Belle, thank you so much for that update. Bloomberg Asia Tech correspondent Annabelle Drulis is there. Up next, we'll discuss all the trade headlines with Claire Reade, who previously worked at the Office of the United States Trade Representative. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. U.S. President Donald Trump announced a 100% duty on branded or patented pharmaceuticals starting October 1st. Let's get insights from Claire Reade, who previously worked at the Office of the United States Trade Representative. Claire, good to have you with us. Of course, it's not just about tariffs, it's also the kitchen sink. Is this Trump reviving the trade war? I mean, we're seeing tariffs which are steep, which are sweeping pretty much.
Well, he had started investigations under the national security statute of pharmaceuticals and of the kitchen cabinets and of the heavy trucks. And so his announcement today of his tariffs on all three of these sectors wasn't a surprise. The details are a little bit of a surprise. So, for example, the China hawks had been talking about the supply chain stresses and vulnerabilities related to U.S. reliance on mostly generic drugs. But this national security investigation, according to President Trump, is only going to be putting tariffs on branded or patented pharmaceuticals. So generics are not going to be subject to these up to 100% tariffs.
So how are we making sense of it? Is Trump indeed targeting the likes of China and India, or how should we be reading it?
Well, I think we need to read it more as Trump trying to press for investment in the United States. So he's looking for the high-value pharmaceutical companies to be moving production to the U.S., given his focus on invigorating U.S. manufacturing. He is not a rabid China hawk, as we have seen. He seems to be interested in negotiating with China rather than just blocking them out of world trade.
Claire, will it work? Could pharmaceutical companies diversify, look for alternative markets, invest somewhere else?
Well, it's multinational pharmaceutical companies are going to have to be making a lot of decisions. And since these tariffs are supposed to go into effect October 1, it's a very short time frame. So for companies that have already invested in the United States, perhaps they will feel like they are okay, but everyone else is going to be scrambling on the innovative pharmaceutical side for sure. And the generic drugs, unless you are part of the European Union or probably Japan and perhaps a few other countries where the countries have negotiated deals with the United States, everybody else, so India and China, for example, are going to have their reciprocal tariffs on those generics. So India right now is at 50% for many of its products. I haven't checked where their generic tariffs are right now. There are some tariff exemptions, but generic drugs are not going to be necessarily free of tariff.
Claire, however you slice it, we're seeing tariffs stacking up. We're seeing 28 revisions to the U.S. tariff codes. It's getting really complicated to trade with the U.S. How might this play out? Might people have a rethink of how they do trade?
Well, I think what we're seeing now is that this national security statute is being used very broadly. And it's an area where President Trump probably feels quite confident legally that he will be able to put tariffs on under this statute. It'll be very difficult for the courts to review what he's doing. So unlike the broad so-called reciprocal tariffs that he started in April of 2025, which are now being challenged in court, these other tariffs in these sectors are likely to stay. So it is going to be confusing and difficult for businesses. On the other hand, businesses know their markets, and if consumers in the United States are a major market, or you have a supply chain where you really need the components, if you are a U.S. manufacturer, then they're going to try to find ways to mitigate the costs, but they're not probably going to stop importing. Prices are going to go up.
And of course, Claire, all these sweeping tariffs are happening against the backdrop of countries like China and India still negotiating their trade and tariff deals with the U.S. How should they approach the negotiation? How complicated is it for them right now?
Well, again, this wasn't unexpected because these investigations have been ongoing for a while, and there have been signals through the negotiations with the EU and Japan, for example, which are already very advanced, that some of these products were going to be affected. So I would imagine that both India and China negotiators have been thinking about how they want to position themselves in these negotiations with the U.S. We've already seen with China that they believe they have leverage in a number of areas, including, of course, rare earths, and they will probably be trying to set up some kind of a balanced negotiation outcome. They also have been, as you I'm sure are aware, very constrained in the imports of many other U.S. products this year relative to previous years, from automobiles to aircraft. So China is obviously thinking about its strategy.
And in terms of China's strategy, it's also about dumping its cheap products to other markets, finding alternative markets to the U.S. We've seen that in the latest data so far. How might this play out? What are the implications for the rest of the world when it comes to trade and supply chains?
Businesses are in a very difficult position right now because there is not a stability or a predictability on this tariff front. That's number one. And that is probably not going to change fundamentally because of Trump's deep interest in using the tariff as a negotiating tool for any situation that arises. So there's going to be much more uncertainty than there has been already. And the other problem, of course, is the increased cost. So, businesses are looking for options to shift supply chains, diversify in how they supply various markets. And then they're also looking at how they can potentially mitigate the tariffs by being more sophisticated in how they actually even do their customs processing.
Claire, we know that you advise Chinese companies operating in the U.S. What are your thoughts on the TikTok deal? What implications are there for perhaps other foreign companies, with apps in the U.S.?
Well, I think TikTok has gotten Trump's attention and therefore has been given more special attention than maybe other apps will. I think Trump has felt that TikTok was helpful to him in his presidential campaign. So he has a vested interest that's different from what may be the case for other apps. So I wouldn't necessarily, if I were another app, take too much comfort from that.
Is this part of U.S. tech nationalism as well, Claire?
Yes, I totally agree with you. The China hawks in Congress have been very focused on some of these areas, although I will say it seems as if the administration overall now is more focused in the tech space on the AI issues than they are in some of the other areas of technology. So expect some uncertainty and rough waters in that sector.
Claire, thank you so much for your time today. Claire Reade, former Assistant U.S. Trade Representative for China Affairs. Now, coming up on the show, we'll get insight on the Indian economy as government and central bank officials prepare to meet. Our panel of experts will be joining us next. Keep it here with us. This is Bloomberg.
We think that, China and U.S. technology companies know that they have to get in front of AI in order to thrive over the course of this business cycle, and we think investors do as well.
The interest in China, AI in particular, has been on our radar for a while.
I think that China recognizes that AI is the future, just like the U.S. does. We've seen the advances in open source AI models coming out of China and think there's a lot of innovation there.
We think that there is space for global investors looking to diversify outside the U.S. Tech space, especially for those who feel that valuations there are particularly overstretched and looking to build more valuations in Asia.
Some of our guests this week sharing their insights on AI. Now, the global exuberance for all things AI is taking the backseat today as traders shift their focus to President Trump's latest tariff pronouncements. Healthcare and auto stocks in focus after he announced a 100% tariff on branded or patented pharmaceuticals and 25% levies on heavy trucks. We're also keeping an eye on the Indian rupee and bonds, which are just coming online. India's government and central bank officials will meet this Friday to decide on the fiscal second half borrowing plan. Our senior FX and rate reporter Subhadip Sarkar joins us now for more. Subhadip, what is the bond market expecting on the borrowing announcement?
Good morning, Haslinda. So the government and central bank officials are meeting today to decide on the fiscal second half borrowing that will be from October to March period. We are just ending the first half borrowing with a 8 trillion rupee borrowing program. The second half is slated at 6.8 trillion rupees, or roughly about $77 billion. The broad expectation is that the number will be unchanged, with the government kind of sticking to its plan for now. The one interesting thing which the bond market is looking out for is what the supply of the longer papers are. That is primarily in the 30-year to 50-year bucket. How much does the government borrow in that segment? Because that has been a pain point for the market with the demand coming off a bit. The backdrop of the borrowing program comes amid, of course, the 50% tariffs which have already kicked in for U.S. exports, and also the H-1B visa plan. So the fiscal thing is also on the mind of the government. It has already kicked off a consumption tax cut, which is expected to see about 480 billion rupees of revenue loss. So that is the backdrop against which the borrowing announcement is due.
So, but why has there been concern on the long bond supply?
Yes, Linda. So interestingly, what has happened in the post-COVID period, I mean, we have seen the pension funds and insurance companies have kind of seen a large growth in business in India, and that has contributed largely to the financialization of savings and the kind of demand that, as we have seen in the last few years in the bond market, especially on the longer papers. But of late, we have seen a bit of a slowdown in that demand. One, on the pension funds, because the pension funds have moved a bit on equity, with regulations now allowing them to invest a bit more in equity. So we have seen them shift a bit to equity from bonds. While on the insurance side, the premium business has slowed down a bit, which is kind of getting reflected in the bond market. Supply for longer papers tapering off a bit.
And of course, all eyes on the RBI policy decision on October 1st. What is expected?
Right. So after the borrowing numbers come in today, the main focus will shift to the RBI policy on Wednesday. The bond market is not expecting, with the swaps pricing currently, no cut for October, but a cut probably in December. Economists are more split on the matter, with kind of it's split down the middle on whether the RBI will kind of go ahead with a cut or want to hold back. So it will depend on the governor's reading of the panel's reading of the situation, on whether they want to put forward the cut earlier or want to hold back to see how the global developments and the tariff issues pan out.
Subhadip, thank you so much for that. Bloomberg Subhadip Sarkar there. Let's bring in our panel of guests to discuss their India outlook. Joining me in the studio, Pranjul Bhandari, Chief India Economist at HSBC, and Shibani Kurian is Head of Equity Research at Kotak Mahindra Asset Management. She joins us from Mumbai. Good to have you with us. Pranjul, let's start with you. What are your own expectations when it comes to the borrowings for the second half? We have heard from the Chief Economic Advisor in India saying that there'll be no change.
Yes, I would sort of agree with him at this point of time. I think it's very difficult to tell at this point that there will be a fiscal slippage and more borrowing will be needed. So I expect no change in the headline number. But there could be some change in terms of the long paper. There has been some stress in the market that the supply of the 10 to 30-year paper has been extremely troubling, has been extremely high. So they may bring that down a little bit and increase the 5 to 10-year paper. So I think some mixed changes there, but overall the headline number I think will remain unchanged.
Why is there optimism there'll be no fiscal slippage? I mean, India is one economy that's under increasing pressure, especially on tariffs. There's a lot of pressure for the government to spend even more to help consumption in the country. Fiscal slippage is at risk.
I agree with you. It is. But we still have some time to go, as in the fiscal year ends in March. So we still have about 6 months to wait and watch what goes on. It's sort of a binary situation in India. If the 50% tariff is lowered, then a lot of these export incentives and all of these fiscal expenditure won't be needed, and it'll be easier to meet the fiscal deficit target. But I hear you when you say that there are other pressures. For instance, personal income tax collections have been weak this year, and that's a pressure we need to watch out for clearly. But on the other hand, because oil prices are so much lower, oil companies will give larger dividends to the government. So there are many sort of pulls and pushes. So we still have some time to wait and watch.
Oil prices are lower at the moment, of course, at risk if anything happens in terms of geopolitics. Shibani, just to get you into the conversation, of course, this is something that the market's watching really closely when it comes to borrowings in the second half. How are you looking at it?
So from our perspective, and especially where the fiscal is concerned, I would tend to agree that given that the government has been so focused in terms of maintaining fiscal deficit targets, we will have enough levers at play to ensure that by the end of the year, we will possibly get to the fiscal deficit number that was announced in the budget. However, at this point in time, there are uncertainties, and what we have been seeing is a concerted effort, both from a fiscal as well as from a monetary policy perspective, to boost consumption. So if you see what happened during the budget, there were announcements which brought about income tax cuts for the mass segment or the mass income segment, and that helped in terms of boosting consumption. This, together with the recently announced GST rationalization, as well as the 100 basis points of policy rate cuts announced this calendar year, our belief is that that altogether should help in terms of boosting domestic consumption, especially at the affordable or at the mass levels, which is something that has been missing from a growth perspective, and therefore that's where the policy focus is at this point in time.
So when traders talk about the concerns to do with demand-supply mismatch, that's overblown?
So from a bond perspective, yes, if you look at the way the yields have been, there have been some amount of demand-supply mismatch, which has resulted in the yields moving up. But from a monetary policy perspective, couple of things. One, the RBI is clearly focused in terms of providing adequate liquidity to the system, and that is a change that we've seen over the last few months. The second factor is that from a fiscal perspective, our belief is that fiscal deficit targets should be largely aligned, and there would be adequate levers from different sources for the government to be able to meet their fiscal target at the end of the year.
And Pranjul, of course, the rupee is front and center. We're looking at a currency that's hovering at record lows. How do you think the RBI is looking at the weakness of the currency?
Yes, I'm sure it's going to be at the back of their mind, especially in the run-up to the 1st October policy meeting. But overall, my sense is they would eventually think about the inflation and growth sort of mismatch. Now, what's going on in the rupee is that we have the trade deficit that is widening. Exports are weaker than a couple of months ago. Imports are higher. So the current account deficit is widening at this point of time. And inflows have been very weak. We've seen about $15 billion of equity outflows since the start of the year. FDI inflows, at least till May, were quite weak. So our sense is overall the balance of payment is not as strong as it was in the last couple of years.
So no need for RBI intervention, you say?
Well, RBI has been intervening on the side, trying to basically smooth out the volatility. But in a way, I would say that it's also allowing the rupee to depreciate. We have seen a fair amount of depreciation in the rupee, despite it being a period of soft US dollar. So I would say it's relatively more hands-off than perhaps same time last year. But yes, when it looks at its policy meeting on 1st of October, I think it will be thinking more about growth and inflation than the rupee.
So what assumptions are you making about the US dollar that would impact the performance of the rupee going forward?
Well, at this point, our sense is that if the softness in the dollar continues, then on the margin, that will provide some breathing space to the rupee. Already, a lot of the adjustment in the rupee has happened. In the rear and near trade basis, it has already depreciated about 7 to 8%. And I think a lot of the bad news is already in the price at this point of time. So if there's going to be some good news in the next month or two, for instance, if the 50% tariff is lowered, I think the rupee could rebound significantly.
And Shibani, you agree with that view that all the bad news has been priced in? If you take a look at the rupee, I think it's 30% weaker versus the USD year to date. It is the weakest currency in Asia. How is this factoring into your own investment calculations?
Yes, so the rupee clearly has been one of the currencies that have been the weakest in this calendar year to date. And as you mentioned, this is despite the fact that the US dollar has been weakening as well. A lot of what's happening in terms of flows, especially on the FII side, as well as the uncertainty relating to the trade and tariff related pressures that India is seeing at this point in time are playing into what's happening on the rupee. Of course, if over the next few quarters we see some sort of an agreement come through between the US as well as India as far as the trade and tariff situation is concerned, that can help in terms of stabilizing the currency. But from an overall perspective, the view would be that given the current uncertainty that is there as far as exports are concerned, a weaker currency will possibly help offset some of that. And from an RBI perspective, I think they are more focused in terms of controlling volatility as far as the currency is concerned, rather than trying to manage the currency in any form.
Pranjul, what is the biggest risk for the Indian rupee right now?
My sense is if the 50% tariff stays on till, I would say, March 2026, which is the end of the fiscal year, I don't think markets are pricing that in. There's a general sense that the tariffs will be lowered in the next 1 to 2 months. But if that was not to happen, I think that would be a downside risk to all asset classes, not just the rupee.
Pranjul, Bhandari of HSBC and Shibani Kurian from Kotak Mahindra Asset Management will be staying with us. When we come back, we'll look at how the latest tariffs from Trump could impact India, especially with drugs in the crosshairs. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Let's do a check on how Indian markets are shaping up as it kicks off its trading day on the back of President Trump's renewed tariff salvos, setting a challenging day for assets in India. The market is more exposed to some of the specific measures already announced, and we're seeing that pretty much playing out across the board. The Nifty and Sensex are down for 5 days in a row. Indian pharma stocks in focus after what we said, that Trump imposing that 100% tariff on branded or patented drugs starting on Wednesday. We're seeing Indian pharma under pressure at this point in time. Sun Pharmaceutical in particular lower from the get-go by almost 5% right there. And we have the Sensex being dragged down along with the Nifty index. And taking a look at where we are in terms of the Nifty Pharma index, it is lower currently by about 2%. Of course, this against the backdrop of a very weak currency, the Indian rupee trading close to record lows, if not at record lows as we speak. Let's get more on the impact of U.S. tariffs on India with Pranjul Bhandari, Chief India Economist at HSBC, and Shibani Kurian, Head of Equity Research at Kotak Mahindra Asset Management. Shibani, let's start with you. It does seem like with all the bad news, you should just be underweight India.
Well, I would believe that if you look at India has been facing a significant amount of volatility because of all the bad news that we've been seeing, both in terms of flows as well as trade and tariffs. But let's look at a few points. One, if you look at the domestic economy appears to be holding up fairly well. The second is from a government perspective as well as from a monetary policy perspective. The focus is on getting consumption back on track, and therefore that has seen a significant boost over the last few months. The third aspect is earnings. Indian earnings for corporate India have been weak over the last 4-5 quarters. However, now we believe that from here on, especially going into the second half of the year, corporate earnings should start to improve, given the fact that demand is likely to also see some amount of boost because of the policy initiatives. In that context, today, when you look at India's valuations, especially for the Nifty is trading at a slight premium to its long-term average multiples, and India's premium multiples as compared to the emerging market pack has also come down to its long-term averages. So our view is that yes, in the near term, there is bad news and there is volatility. But if you look at slightly medium term, valuations are now coming to a level, especially for large caps, where it is becoming more and more reasonable. And even on a relative basis to emerging market, India's valuations are now looking far more reasonable and in line with long-term averages.
But some say even with a sell-off, Indian valuations are still expensive, and perhaps in the context of other emerging markets, there are more attractive markets like China, like Korea. So India doesn't look that attractive anymore.
So I think you have to look at it in three parts. When you look at large cap, especially when it's the Nifty valuations, both in terms of its own history as well as with respect to the emerging market pack, has now come down to long-term average multiples. Where valuations for India are still elevated is specifically in the small cap segment, where if you look at vis-a-vis history, we are trading at about 30 to 40% premium. And that's the segment where earnings growth has also been muted. However, where large caps and some of the mid caps are concerned, we believe that earnings have been holding up fairly reasonably, and that's the segment where we believe that valuations have become reasonable. So yes, there is one part of the market, especially the small caps, where one needs to be cautious and be very stock specific. But where the large caps are concerned, risk reward appears at the margin to be turning favorable.
Pranjul, Shibani talks about how the economy is still resilient given the boost from the cuts in GST. I'm just wondering, though, America First policy, is that putting Made in India at risk?
So I think there's both good and bad news on the economy at this point of time. I think the bad news is the 50% tariff, the more expensive H-1B visa, and also the pharmaceutical tariffs that were announced today. Overall, if they stay for a year, my sense is GDP growth can be 0.7 percentage points lower. And I think that's a pretty substantial number. But on the positive front, we have inflation falling to, multi-year lows, which increases purchasing power for mass consumers. We have the GST cuts on the back of the income tax cut, and our sense is that can actually raise GDP growth by about 0.5 percentage points. So it's sort of like a very interesting pull and push out there. A lot will depend on whether this 50% tariff continues for the next 6 months or so. If it does, I think it's net bad for the economy. But if it's watered down to about 25%, I think the fact that rate cuts have happened, some reforms have happened, India could come out stronger on the other side.
If the 50% tariffs were to remain longer term, what can the government do to counter the impact?
Domestic reforms, as in the GST tax cut was important, but what was more important was the improving the backbone of the GST regime. I think there were some changes made there. I think that was a good reform, but eventually we need many more reforms. There's a deregulation drive going on across central and state governments. If it continues, I think that will be good for ease of doing business. My sense is that the government is doing a lot in terms of external reforms as well, reaching out to different countries, trying to sign more trade pacts, lowering the own import tariffs that it charges on its imported inputs, being more open to perhaps Chinese FDI. I think these are great reforms. If we continue, then we can offset the impact of the 50% tariff, but it will take time.
Shibani, how best then to play the Indian market, given that the economy looks pretty much intact? It could be those players linked to the domestic economy?
Absolutely. So the way we are approaching Indian markets from an equity perspective is to look more at domestic-facing sectors. One is, of course, as we were discussing, the considerable boost that consumption as a whole, especially the mass and affordable consumption, has received from a policy perspective. The second factor is if you're looking at the rural economy in India, real rural wages after a period of 5 years have turned positive and are now starting to improve. So therefore, there is an impetus there, and therefore sectors which are linked to consumption, specifically discretionary consumption, whether it be the passenger vehicle segment, the two-wheeler segment, retail, travel, tourism, or even quick commerce. These are segments which we believe will benefit in this sort of an environment. We'll also, of course, have to look at stocks more bottom-up. The way our approach has been is to figure out where there is visibility of earnings, and of course valuations are reasonable. As we were discussing, in pockets, specifically where small caps are concerned, valuations are still elevated, and therefore the best way to approach Indian markets is to be a little bit more tilted towards large caps where valuations are reasonable.
Well, it's not just about US-India relations, it's also India-China relations. We're beginning to see that thaw in relations between Xi Jinping and Narendra Modi. Is that still a theme? Is that a way to trade it?
So I think we'll just have to wait and watch. The entire trade tariff dynamics between US, India, China, the rest of the world is still evolving. There is something happening on a regular basis. I think in this sort of an environment where there is considerable amount of uncertainty, the focus clearly has been in terms of keeping the domestic economy alive and improving. So the way we are approaching markets is take it one day at a time. There is considerable amount of uncertainty. The good part on this entire equation is that domestic flows, specifically into mutual funds and asset managers such as us, has been strong. And therefore, if you look at the numbers, calendar year to date, domestic institutional investors have been net buyers of Indian equities to the tune of more than $60 billion. So therefore, that is providing the support required to the market in this period of uncertainty. But given the way things are, I think we will still have to encounter and muddle through near-term volatility until and unless we come to a final agreement as far as the trade and tariff situation is concerned.
And Pranjul, I imagine that the RBI stands ready to boost the economy as well. We could see perhaps deeper and more rate cuts if needed?
I think so. So we have the meeting on 1st October. It's a very close call, but our sense is it could be on hold at this point of time. Agreed, inflation is very low, but we haven't seen growth fall a lot. So at this point, it may want to keep some powder dry for a later month. But my sense is by the time we come to December, Diwali festival will be behind us. There will be nothing exciting to look forward to. And if the 50% tariff sticks by then the RBI will cut in December and could also cut in the next policy meeting, which is February. So a couple of rate cuts is still on the offing if growth remains weak on the back of the 50% tariff.
How much pressure, I wonder, Prime Minister Modi, whether he's under a lot of pressure given that, it's against a backdrop of growing unemployment among the youth. Pranjul Bhandari of HSBC and Shibani Kurian from Kotak Mahindra Asset Management, we thank you so much for your insights today. Before we go, here's a look at the guests who will be joining us next week. NAVA's President of Investments, Namsoon Kim, will be joining us live from the Milken Institute Asia Summit as business leaders gather to discuss mega trends. We'll also be at Token 2049 here in the Lion City, where we'll unpack the outlook for crypto markets with Robinhood, Ethereum, and Circle. That's it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.